Hello, this is Brian Rezny, president of Rezny Wealth Management. We have a great show for you this morning. Of course, if you have any questions about your portfolio, send them to Brian Rezny at ReznyWealth.com, and we'll try and get as many questions as answered as possible. You know, I'm going to talk a little bit about the economy, and I do this before I start every program, just to kind of give you an idea what we see in the general environment. First off, U.S. economy overall, if I compare it to economies over in Europe or the emerging market economies, currently we're one of the strongest places to invest financially. And what I mean by that is earnings and valuation. I still like the U.S. economy, and I like it more than other economies around the world. Number two, we are currently not in a recession, and we are not seeing signs of a recession, again, currently. We do a lot of internal research at my firm, and one of the things that I talk about often are recessions. If we actually started seeing signs of recession as a firm, because we manage money for our clients, we would actually reduce equity or risk exposure within a portfolio. I suggest you do the same, but right now, no recession on the horizon, and we have a good crystal ball, in my opinion, between 6 and 9 months out. Next, interest rates are low. You're not going to make a lot of money in interest, and that's the bottom line. I expect rates to stay fairly stable for the rest of this year, and all that means is not a big rise in interest rates, maybe a quarter to another half a point by the end of the year, depending if the economy stays strong based upon what Janet Yellen has stated in her testimony. So again, if you own bonds, don't plan on making a lot of money in bonds, and generally speaking, you want to be a little bit more defensive on bonds. Own high quality corporate bonds, not junk bonds, and own short-term duration treasuries, usually under around 3 to 5 years currently on both sides of the duration. Be a little bit more defensive on your bond side. Do not chase yield. I again repeat that. Do not chase yield, because if rates slowly do move up, bonds come down in value as rates go up. Just remember that. You know, today's topic, and it's one that comes up a lot, and it's important rules for investing today. And I want to stress this. We receive just a tremendous amount of calls and questions on my TV and my radio show. By the way, my radio show on Sunday mornings, 10 a.m. to noon throughout Florida. Go to ReznyWealth.com. But we receive a lot of questions about investing. And I want to go through some of the important rules that we believe in and that we believe you, the investor, should follow so you do not get yourself into trouble with your overall portfolio. And let's start with rule number one. Never put yourself in the path of being forced to sell an asset after it's already taken a huge tumble or a huge loss. Think about this. Let's say you're 65 years old and you need income from your portfolio. Let's say you have $1 million portfolio and you need monthly income from that portfolio of, let's say, $5,000 or $6,000 a month. Don't invest all your money in equities where every month you're forced to sell an equity that's down in value to generate your monthly income. Have a significant amount of cash or short-term bond alternative investments, usually between 3 and 5 year time frame within part of the structure of that portfolio. I do not want to be forced as a money manager to sell investments that are down 20% as an example in order to generate short-term income for a client. We just won't do that. So you, the investor, though, I find this often happens to a lot of investors. They don't follow that strict rule, which is keep enough cash on the sidelines for general living expenses for the next 3 to 5 years or short-term duration bond type investments. Again, you're not going to make a lot of money, but you also don't have a chance to lose 20% either in the short term, and then you're forced to sell something that's down 20% on a monthly basis. Number two, most investors are constantly changing their portfolio holdings based upon market movements, not investment strategy. Emotions and news drive most investors' investment decisions. Let me explain. As a money manager, and again, Rezny Wealth Management is a fee-only fiduciary money manager. We're not a Wall Street firm. We don't sell investments. We don't have those conflicts. And we don't sell annuities. We're not annuity salespeople. We're an actual money manager. And one of the things that we do as a firm is we follow a strict rules-based investment strategy. And we follow those rules. And the reason we do that is if you follow a rules-based investment strategy, you are much more likely to be successful with your portfolio over a period of time. That's been proven in many, many studies. By just buying and selling based upon emotion or every knee-jerk reaction to the news is really a recipe for disaster and mediocre returns. There's been a major study, I think for 3 decades now, the Delbar study, and it looks at investment returns and it looks at investor returns, meaning here's what the investments made over that time frame, here's what you, the investor, made. Usually half or less what the investment market's made, because a lot of investors are jumping here to there and doing all this kind of crazy emotional stuff with their money and following news sources from Wall Street, which again to me is a recipe for disaster. So again, what's your strategy? You need to follow it, and emotions and news is not a good source of an investment strategy at all. Avoid using leverage. It amplifies the negative returns and seldom helps you to make money. Let me explain. Often, I will get a call on my radio or TV show about, hey, Brian, I use margin in my portfolio. Don't do it. Or I'm going to buy a levered ETF, meaning they borrow money, they double down on a particular stock or a sector. Don't do it. While it may look great on paper that you may have the potential to make bigger returns, I have seldom ever seen anybody use leverage correctly, and I have seldom, if ever, seen anybody use leverage and actually make a return. They often make lesser returns and have more losses in their portfolio. I'm trying to give you these talking points so you don't use leverage. By the way, I often find a lot of Wall Street firms want their clients to use margin because they can actually sell you more investments on margin and actually make bigger commissions. Don't take that advice. Investors need to have a plan. Without a set of rules and guidelines, there is little that will guide an investor's actions, and the markets will go against you. You need to know what you're buying and the reasons why, and if those reasons why you bought something change, that's a reason to change the portfolio. Not on short-term volatility or market news, which I deem as noise. You need to follow a set of principles. The reasons you buy, what drives that? The reasons you need to sell and when, what drives that? Usually a change in fundamentals from being positive to negative would drive somebody to sell a sector or a particular investment. You need to follow rules, otherwise you will not be successful. If you wish to make money, you have to take risk. You cannot avoid risk in a portfolio if you're trying to make a return on your money. I will often get calls from investors and say, Brian, are there any safe investments I can put my money in that have no risk or volatility? The only one that I will tell you that has no risk of volatility or potential loss is a CD at the bank. And a CD at the bank is, again, FDIC insured. You're not going to make much money today, but that's really the only investment. I don't care if you buy government treasuries, gold, equities, ETFs, mutual funds, you're going to have some degree of volatility. Do not let anybody tell you what they're selling you has no risk. If you buy an annuity, you've got a ton of risk. Remember that. As an investor, every investment has risk. If you can't accept any volatility in your portfolio, that doesn't mean you physically lost money. It just means it changes values daily. If you can't accept volatility, then you're best to put your money in a safe investment like a CD. You won't make a lot, but again, then you won't make emotional decisions that will cause you to lose more and even make a lot less. Terry from Cape Coral, Florida. What qualities should I look for in an advisor? Terry, excellent question. Number one is this. Go to my website, reznywealth.com. Download for free. It's a questionnaire, and it kind of gives you a summary of how to find a real advisor, a real money manager. And the report's at the bottom of the homepage on our website. It's called Your Biggest Investment in Retirement Risk. It's fiduciary versus suitability. So the bottom line is this. Only hire a firm that is fee only, a fiduciary registered investment advisor. It's explained in that free reporting questionnaire. Anybody else, whether it's Wall Street, banks, or insurance companies, are not fee-only fiduciaries. There's some that are fee-based, most are commission. In fact, statistically, less than 10% of investment firms nationwide are fee-only fiduciary registered investment advisory firms. Only about 10%. The rest of the firms have conflicts of interest work under suitability, sell products, meaning their interests are not aligned with yours, meaning they don't legally work for you under suitability. They work for the firm they sell the investments for. So make sure you download that free report. It's groundbreaking, it's free, and it comes with a 12-question questionnaire that you can use in the interview process to find out a real advisor from somebody who's really just using a title and selling you investment products that are complex and not good for your portfolio. Sherry from Naples, Florida. Do you think interest rates will go up this year? Another great question, Sherry. Bottom line is this. I've talked about interest rates for a number of years. We've had basically a 20-year time frame where rates have essentially gone down. The 10-year Treasury's at about 1.8% or so. If the economy is doing well and we're growing, our Fed President, Janet Yellen, has stated multiple times they're going to slowly, again, very slow, methodical, raise interest rates. I think this year rates might go up another 1/4 to 1/2 point. We are on a growth path currently in the U.S. I don't see recessions on the horizon for this year, 2016. And again, our data may change in 3 months or 6 months, and we may update that projection. But right now, we're in a growth environment on the way up. I like what I see. Not fast growth, we should be doing better. But again, based upon our political environment and the overall tax burden that many of us face and the overcomplexity of our rules and regulations, we're not growing the way we should. Maybe our next candidate or our next president will get us on a better path to grow our overall economy, which that means everybody ultimately does better. But I think rates will go up very slow this year, 1/4, 1/2 point. Be in short-term duration bonds, avoid mutual funds, and avoid high-yield bonds in addition. Ted from Naples, Florida. What do you think about China's economy and how will it impact the U.S. investment markets? Ted, there's been just a tremendous amount of talk about China. In fact, if I go back to 2015, we had that market correction about 8 to 10%, sometime around, let's say, August, September. And the news then was China's going out of business, meaning they're going to zero, which obviously is really not the case, but that's how media sensationalizes stuff. So the market sold off. China's economy is big. It's the second biggest economy in the world currently. And ultimately what's happened with China is they were growing their economy at about a 10% GDP level. That's down to about, let's say, 6.5%. They're still growing pretty fast for a big economy, but they're not going to be able to grow as fast as they once did. That's just a law of numbers. So remember this. Slower growth does not mean that the world comes to an end. I think China's economy in the next decade or two is going to be the biggest economy in the world if they keep on the growth path that they are currently at. I don't think their economy is going to implode. Yes, we're going to get some short-term volatility year by year. If China says the wrong thing about their growth of their economy, that's normal for the markets overall. So I wouldn't be worried about China. In fact, China might even be an opportunity you may want to consider investing some money in with a portion of your portfolio, as long as you've got a 3 to 5 year time horizon and you can handle a little bit added volatility in your overall portfolio. I'm going to take a short break, folks. Please go to my website, reznywealth.com. And as I've always said, if you're concerned about the advice you're receiving, if you're second-guessing your advisor's intention, if you want to just sit down with myself or my firm and talk about your portfolio, call us. Schedule that second opinion appointment. It's vital for your financial future. Let's talk. Let's get you back on track. Call the number on the bottom of the screen or visit our website, reznywealth.com. I'll be right back after this. Hello, this is Brian Rezny. If your goals are to increase your retirement income and retire without stress, go to my website and download our groundbreaking free report. This free report covers the investment and retirement pitfalls that are often overlooked even by the smartest investor. If you're concerned about outliving your money during retirement, or maybe you want to make sure you're not leaving money on the table, this free report is for you. Know the facts. Your retirement depends on it. Go to my website, reznywealth.com, and download your free report right now. And we're back. I hope you're enjoying today's program. Of course, we're talking a lot about the investment markets. We're taking your questions. Send them to Brian Rezny at ReznyWealth.com. And do make sure you visit our website, ReznyWealth.com. You can sign up for a consultation via our website, or you can call the number on the bottom of the screen. I know we do get a number of phone calls after any of my TV or radio shows. And make sure, by the way, I do a live radio show every Sunday mornings from 10 a.m. to noon Eastern. Go to my website for times and availability throughout Florida. You'll be glad you listened. You'll learn a lot. But as I've always said, if you have questions, send them to my firm. We'll be more than happy to answer those on air. And you can always call for a second opinion consultation if you're concerned about the advice you're receiving or the direction of your portfolio. Chris from Naples, Florida. Where can an investor find safe income? Chris, there really is no safe income. I never like to use the word safe. The only real safe investment that is out there is a CD at a bank. That's it. And today you might make 1% on a one-year CD. That's about it. If you want the opportunity, I'd rather use that word, to make a better return than 1%, you're going to have some volatility in your portfolio. And remember, volatility doesn't mean loss. It just means investments fluctuate day by day, week by week, month by month. And as long as you're a 3 to 5 year investor and you want the opportunity to have the ability to make better than a 1% return, you're going to have a well-managed, diversified portfolio. That's the bottom line. I have never seen an investor be successful that will not take some degree of market volatility, whether that's in the bond market, gold, or the stock market. It just is not going to happen. And unfortunately, a lot of people get looped into sometimes, and I'll kind of bring this into the fold, these equity index or these hybrid annuities that have been written about a lot and really labeled in the wrong way. Annuities have risk, folks. And I get a lot of investors that will ask me, I heard that these things pay 8% returns or they give free money bonuses. There is no annuity, none, zero, that have no risk. You're going to have some risk in an annuity. The insurance company can go insolvent. You could pull money out before the surrender penalty is gone, and you could take a big hit that way. There's risk in everything other than a CD at the local bank. So remember, there's no 8% returns with any annuity. There's no 10% free money bonuses. You as the investor need to read the fine print, and somebody trying to sell you on those kind of returns with an annuity should never be trusted. Albert from Naples, Florida. I have a 401k plan rollover for about $850K. How should I invest for growth as I don't need current income? Albert, really the way you're going to invest that portfolio is based upon your goals and objectives and your risk profile. So what I would say to you is this: the way that I would recommend that you invest that money, and maybe another 20 clients, could be completely different. But I will say this: if you're looking for growth and you can handle some volatility in capital and you do not need current income, I would be looking more for the U.S. marketplace. A couple things I might look at. Small cap in the U.S. I really like the small cap. Fair disclosure, we currently have positions in small cap in the U.S. And I do like the equal weight S&P 500 is another area. So those are kind of two areas you might want to take a look at. The other thing, Albert, you may want to consider calling my firm for a consultation. Let's sit down, do a more thorough research of your situation, and maybe we can really put together a plan, an investment plan that makes sense for Albert and his family so we can help you meet your overall objectives. But I like small cap and I like the large cap equal weight in the U.S. right now. I would stay out of Europe or developed countries outside the U.S. currently. They're going to have very slow or negative growth, and I think some of the recent turmoil overseas is going to only hurt earnings, meaning their stock market's probably not going to do as well or have the potential to do as well as I think the U.S. marketplace overall will. Fred in Cape Coral, Florida. I invested a large amount of money in my IRA into a master limited partnership based on a broker's recommendation for high income. They've lost 50% plus of their value. What would you do now? First off, Fred, I would never put all of my money or a large chunk of my money in one sector. Number two, I've repeatedly talked about master limited partnerships for the last probably 3 years. And I've been telling investors to avoid them for 3 years because they were grossly overvalued. What your broker basically did is he probably heard you say you're looking for a high income. He basically picked a bunch of master limited partnerships. I'm guessing this is what happened. And he put those in your portfolio. Anything that pays more than about a 3 to 4% dividend stream should be suspect. And master limited partnerships, we're paying probably in the 5 and 6% range probably when you bought them. So again, suspect. But if I look at valuation, and valuation does matter, if things are overvalued and you buy them, what's going to happen is one of two things. Either that price is going to come way down to valuation levels that are realistic, or the earnings of that company have to come way up over time in order to basically make up for the overvaluation of that stock or stocks you own. With master limited partnerships, what's happened is oil prices have come down. So of course, it's hit the value of these stocks. I personally think oil prices are going to stay lower than normal. I don't think we're going to see $100 oil prices anytime soon. We'll probably stay in that $40, $50 range for a number of years because of technology and online supply that we're bringing. That's one of the big issues. And the other thing that's happening with some of these master limited partnerships right now is they're starting to actually cut that dividend. So not only have you lost 50, 60, 70% of your value, but they're going to start cutting the dividend on some of these. I've already seen it. That's a negative. That means the prices could be lower. So this is what I would tell you. If you're buying into an investment sector, never own more than 10% of that one individual sector in your portfolio, because if it goes south, you don't want half of your portfolio going south 50%, a portion. You need to have sell signals and sell rules in your portfolio, which you clearly did not. The problem is now, what do? I would sell half of my positions right now, and I would wait a year and I would sell the remaining half of those positions. I would get out of the master limited partnership game. I think prices are going to stay low and depressed because oil is going to stay low and depressed, and I think a lot more dividend cuts are here to come, meaning lower prices in master limited partnerships. Bob from Naples, Florida. I own Exxon stock. It's about 22% of my portfolio. It's taken a big hit with oil prices. What do you think about Exxon? Bob, I think Exxon as a company is great. As an investment, not so much. And owning 22% of one stock, that is crazy. My rule of thumb is this. If you're going to own individual stocks, never own more than 5% max of any one individual stock. No more. If it goes over 5%, you trim your position. But the problem with Exxon is oil. Oil's come down. Exxon's going to make less money if oil prices stay down, and I think they're going to stay down, as I made a comment on my last question. If you take a look at Exxon stock and you match it up against the S&P 500, even market cap weighted index, which you can buy through an ETF format or investment, more diversification, Exxon has greatly underperformed the S&P 500 over 1, 3, 5 years, and even 10 years. Bottom line is this. You own too much of Exxon, trim your exposure to down to 5% max, invest the money wisely, utilize ETFs. You need to be more diversified. You're under-diversified. You're taking too much risk, and you're not making any money for the risk you're taking. Larry in Cape Coral, Florida. I've hired 4 advisors in the last 8 years. None have made me money. How can I find a competent advisor? Larry, first off, when you interviewed these advisors from the get-go, were they fee-only, fiduciary, registered investment advisors? Okay. If they're not a fiduciary, if they're not fee-only, and if they're not a registered investment advisor, you didn't hire a money manager. You probably hired a salesman or a broker with the title of advisor. So again, a registered investment advisor is different than an advisor. That's number one. I would suggest you go to my website, reznywealth.com. Download for free your number one investment risk, fiduciary versus suitability. It'll talk about how to hire a real money manager to manage your money, a firm that actually legally works for you as a fiduciary. Remember, no Wall Street firm, no bank, and no insurance company is a fee-only fiduciary firm, because most of these firms, if not all, sell product and for commission under suitability. So make sure they're fee-only, fiduciary, registered investment advisor. Go to reznywealth.com, download that free report and questionnaire, and what I suggest you do is call my firm for a consultation. Let's discuss the problems with your portfolio and what you should be doing right now to get yourself back going in the right direction. Dan from Naples, Florida. My portfolio is mostly individual stocks through my brokerage firm. I've heard you say before, avoid stocks. Why? Dan, simple. First off, if you own a bunch of stocks through your brokerage firm in a brokerage account, Dan, you are responsible to manage those stocks. A lot of people think the broker's job is to manage those stocks. That's not really true. If you do not have an advisory account and you have a brokerage account, you are responsible. An advisory account's managed money. A brokerage account is, Dan, you're responsible. So if you have a basket of stocks, you need to be doing research daily on these stocks. So imagine this. Let's say you have a portfolio that is, I don't know, $500,000. It has 30 individual stocks in there. You're going to spend the better part of 40 hours every single week researching those stocks. They need to be researched every week and daily to see if there's changes in fundamentals, growth projections, all kinds of things that need to be accounted for in that portfolio. You need to have a strategy. You need to know when you're going to sell some of those stocks before they drop 50 or 80%. So individual stocks are a ton of work. And what I find is, Dan, investors make less money owning individual stocks. They have more volatility, and they don't know when to sell. And they thought their broker was going to call them, but the call never comes in. So you finally get disgruntled. You sell stocks when they're down 50, 60, 80%. That's not money management. I would suggest you utilize what's called an ETF, exchange traded fund, more diversification, better diversification in a portfolio, less daily legwork you have to research, or call Rezny Wealth Management. We're a fee-only fiduciary money manager, and let us do the heavy lifting so you can go about your retirement or your daily, whatever you'd rather do, than spending a lot of daily time on research in your overall portfolio. I know that I'm getting close to out of time, and I know we have a few more questions and all that coming in, but I want to stress this to every investor. You, the investor, ultimately decides the direction of your portfolio based upon the advice you're either feeding it or the advice you're receiving from your current advisor. Make sure that advice is in your legal best interest. Only hire a fee-only fiduciary money manager. You can call Rezny Wealth Management. Is your portfolio performing the way it should to meet your goals? Are you truly happy with the advice you're receiving? Schedule a review, a consultation today with my firm. The number's at the bottom of the screen. Visit ReznyWealth.com. That's ReznyWealth.com. Sign up for a consultation there. Call the number on the screen. Don't wait any longer. Remember, bad investment advice doesn't fix itself. Make sure you have yourself a profitable day. We'll see you next week.